Imagine if the value of each dollar was based upon physical assets, rather than an arbitrarily agreed upon number on a screen. What if every dollar printed was backed by something tangible, a metal, a scarce resource, gold? That was the reality until the early 1930s. The gold standard tied the world's currencies to a physical foundation, gold. Every dollar, every pound, and every franc represented a fixed claim on it. Governments could not simply create money out of nothing. The supply of currency was limited by the gold stored in vaults and the gold pulled out of the ground. But what most people forgot is that under this system, gold mining wasn't just another industry. It was the heart of the global economy. The miner's pickaxe wasn't only a tool of labor, it was the mechanism of monetary expansion. So what were the true economics of mining gold under a gold standard? What did it mean for growth, stability, and freedom itself? To answer that, we must begin with what the gold standard actually did. Under it, money was defined by a specific quantity of gold. In the United States, 1 ounce of gold equaled $20.67. That fixed price meant the total money supply depended directly upon how much gold existed in circulation. No central bank or finance ministry could arbitrarily increase the money supply. Expansion only occurred when new gold was mined and refined into coin or bullion. As Hayek observed, so as long as the gold standard is maintained, the amount of money in circulation is not determined by the arbitrary decision of the government, but by the profitability of gold mining. In this world, the miner was the silent central banker, their success dictating the rhythm of economic growth. When the economy expanded and demand for money rose, the purchasing power of gold increased. Mining became more profitable, investment in exploration rose, and production accelerated. New gold flowed into circulation, easing the shortage and stabilizing prices. When the opposite occurred, when economic activity slowed or the real value of gold fell, the least efficient mines shut down and production contracted. The money supply naturally adjusted downwards. No decree, no policy committee, no bureaucratic intervention was needed. True demand alone coordinated the world's money supply in a fashion that legendary economist Adam Smith would approve of. This was what Hayek meant by spontaneous order, the idea that decentralized individual decisions, each guided by local knowledge, create a stable system far more effectively than any plan could. He wrote in the Constitution of Liberty, "Wherever the spontaneous forces of the market are not impeded, they bring about a coordination of individual efforts more complete and efficient than any design could achieve." Under the gold standard, that principle extended from merchants and consumers all the way to miners and refiners. But this harmony came with a cost. Mining gold required capital, labor, and energy. It meant vast operations, deep shafts, and years' effort merely to sustain the money supply. Economists such as Milton Friedman called this resource cost of a gold standard, the fact that there was a cost to increase the money supply. Hayek did not dispute that cost, but he viewed it as a form of necessary restraint. In a paper money system, governments can expand the supply of money at virtually no cost. Under political pressure to fund wars, welfare, or deficits, they do. But under a gold standard, expansion demanded effort. Money could not appear without someone first digging it from the ground. Hayek put it perfectly in the denationalization of money. The gold standard is a means of forcing governments to control the quantity of money in the same way as the balance of payments forces them to control the price of their currency. Mining, then, was not wasteful. It was a discipline in physical form. Even so, gold mining followed its own economic cycles. When technology improved through better extraction methods or new discoveries, production surged, increasing the money supply and lowering gold's purchasing power. The resulting inflationary waves could stimulate economic activity similar to credit expansions today. When deposits ran low or costs rose, output declined, tightening the money supply and producing mild deflation. Unlike the artificial booms and busts of modern economies, these fluctuations were tied to physical limits, not policy errors. They reflected the natural ebb and flow of human discovery and technological progress. Even more so, they reflected the proper level of investment as a result of demand and technology. This distinction is central to Hayek's theory of business cycles. In modern economies, he argued, recessions result from distorted price signals, particularly from interest rates manipulated by central banks. Under a gold standard, those distortions are minimal. The rate of interest reflects genuine savings, and the supply of money reflects actual gold output. The miner replaces the policymaker, and the market remains strong. But as economies grew faster than new gold discoveries, long-term tension emerged. The money supply often lagged behind economic expansion, causing gradual deflation. Prices fell, debts grew heavier, and borrowers struggled. For some, this discipline was a virtue, rewarding thrift and efficiency. For others, it was a burden that slowed progress and amplified downturns. Eventually, the strain became political. Governments facing war or economic crisis needed more money than the mines could provide, so they suspended gold convertibility temporarily, then permanently. By the 1930s, the last major economies abandoned the gold standard. The age of physical money was over. Yet, the economics of mining gold under the gold standard still teaches a timeless lesson. They remind us that sound money has a cost, and that cost is what protects its value. When money must be earned through effort, it restrains governments, disciplines credit, and respects true demand. When money can be created without limit, the link between effort and reward weakens, and with it, the link between production and prosperity. Hayek warned of this danger when he wrote, "To act on the belief that we possess the knowledge and the power which enable us to shape the processes of society entirely to our liking is likely to make us do much harm. Gold could not be printed, it had to be found. It was a scarce resource, as money should be. So when you look at a gold coin, see more than metal. See the memory of a world where money had weight, where wealth came from not the press of a button, but from the sweat of human labor beneath the earth." Thank you.